Wonderful evening, everyone. Thank you so much for joining us. It's Sarwa, Trading 101, a webinar that we're going to be hosting today. My name is Eamon Gebre. I'm here joined alongside a colleague of mine by the name of Sari Al-Hashi. Sari, maybe we can start with a brief introduction about ourselves and we can jump into the material that we're going to be discussing today.
Of course. Thank you, Ayman. Hi, everyone. My name is Sari. I work as the head of operations here at Sarwa. I've been with the company for around 5 years now. I come from a finance background, so I do have a master's in finance. I've completed a couple of levels of the CFA exam, and I'm very happy to be here. It's my first webinar, and hopefully you can tell that it's my first webinar. Like the only reason you would know is because I'm telling you. So hopefully all goes well. But I'm very excited to talk to you and show you about our Trading 101 presentation.
It's a pleasure having you, Sadi. About myself, for those who I have not had the pleasure of having a discussion with in the past, again, my name is Eamon Gebre. I lead the advisory division here at Sarwa. Been with the organization just approaching 4 years now, but have been in financial services for well over 20. Worked with organizations such as HSBC and TD Canada Trust. You know, having conversations with individuals to give them guidance and support over the years on how to achieve their financial goals. And today, essentially, is what we're trying to do through our topic, Trading 101. We're going to be discussing really some basics to help you get started when it comes to trading towards your financial goals. It is going to be introductory in nature, and we're going to have an opportunity for Q&A towards the end of the session. So I do welcome you to ask any questions that you may have at any point during the presentation. We are going to be taking them up towards the end. So I guess without further ado, shall we jump into this, Sadi?
Yeah, let's do it.
Amazing. Let's start maybe with highlighting what the agenda is going to be for today. So we're going to be talking about the basics of trading, the types of trading strategies that are often, employed when people are looking to achieve their financial goals. What are the best practices that I think university, that every one of us should be utilizing when we talk about trading towards our long-term goals? How to keep yourself informed. One of the things that Sari and I do hear quite often from a number of users is, well, the market changes so often. How do we keep ourselves, the fingers on the pulse, really, to say? And we're going to conclude, and then we'll open it up to Q&A. Now, as all other previous webinars we've held before, it's important to kind of highlight some important, I would say, disclaimers. The first one would be that, our conversations today are all about best practices. Our views should not be interpreted as one-on-one financial advice. As you can imagine, we all have unique circumstances, and it's important to kind of have a discussion with a financial advisor, or if you have a broker, you can have a discussion with them with regards to what's best for you. And of course, we cannot predict the future. We've got an image here of a crystal ball, and the whole idea is that no one does have a crystal ball. So if we're having, if we're going to have discussions today about what's going to happen in the stock market tonight, tomorrow, or maybe a week or a month from now, unfortunately, neither Sari and I know. What we do know is that there are best practices that everyone can employ in their day-to-day investing strategies, and that's what we're going to be discussing today. So, understanding trade basics. What does this entail? Well, what is trading? Let's start with that. I think it's it's a discussion that we have, and some of us may take it for granted and say, well, everybody understands what is trading, but I think it's important to kind of dive into a little more of the details about what's exactly happening when you're buying, when you're trading. So trading is essentially the process of buying and selling shares of publicly traded companies on the stock market. Now, when you buy a stock, understand that you are taking an ownership position in that company that you're buying into. So let's take, for example, you decided to buy a stock in Google. And maybe you're investing $100 worth of, of capital that you have into Google. You will have $100 worth of ownership in that company itself. Even the act of trading itself, to understand the mechanics, and I get this quite often, Sari, and sometimes I'll hear, hey, look, if I buy these stocks, where's my money held? Well, essentially what's happening is that when you're buying a stock, you're exchanging capital in favor of having shares of an organization. So there's literally an exchange that's happening through a broker in which you deploy the capital, you buy the shares, let's say it's $100 worth of shares. There's another individual on the other end who's selling the shares to you. So there's an exchange where they're receiving capital and you're receiving the shares. And the asset that you're essentially buying is the share ownership in that company itself. And that's essentially what increases or decreases in value over time. And I know it seems quite, common sense that everybody knows it, but sometimes we forget about that. We think about, oh, if I buy this particular stock, my money that you see, the value of the investment that I see, that's actual capital that I have. No, that's an asset that you have that is worth X amount. When you sell, your position in any particular company, essentially you're relinquishing ownership in that company itself, which again, most of us would understand and kind of absorb and know it altogether. But why do sometimes, maybe mix trading and investing? And we hear this quite often sometimes where it's like, well, I would like to trade, for my retirement. I would like to trade for, my children's education fund. But when we start diving into the conversation itself, we're realizing that they're just using the word trade as a verb, but in the sense they're actually talking about investing. So I think it's important to kind of differentiate. What is the difference between trading and investing? Trading, let's start with a few characteristics, is from a time horizon perspective, it's typically a shorter term time horizon. We're talking some days that people are planning, for the day, sometimes for the week, sometimes they're probably maybe thinking maybe for a month. That's the time that they're talking about of holding on to that particular stock when they decide to buy it. That's the time horizon. Investing is typically long-term in nature. And in some cases, we're talking about decades where individuals might hold a set of stocks or a set of stocks within a portfolio for sometimes decades on end. Strategy-wise, when it comes to trading, there are innumerable ways in which you can trade. Some people are day traders, swing traders. Some people are, buy and hold. There's going to be a number of different strategies that we're going to talk about today, but essentially there are multiple different trading strategies, and there isn't one that I would say is uniformly, practiced or uniformly would say is better than the other. There are different strategies that can be utilized for different market, I would say, environments altogether. Whereas when we talk about investing, it's very similar. Investing is primarily asset allocation, risk management, and really you're trying to benefit from long-term appreciation. You're essentially going to hold on to a set of stocks for a longer period of time. And as I said, in some cases, it could be maybe an extended one until maybe into retirement stage. When it comes to risk tolerance, there needs to be an acceptance of risk when it comes to trading. Because typically there's a higher level of a risk associated with trading. Whereas with investing, just due to the strategy itself in which you're looking at asset allocation, which is typically diversification, with a core focus on risk management, typically means that there is a lower risk associated with investing relative to trading itself. Even the frequency of transactions, as I said, some individuals might trade multiple times a day. Sari and I have seen individuals who traded maybe 10 to 12 times in a given day, and sometimes even similar set of stocks or even the same number of stocks as well too. Whereas investing typically has a lower number of transactions. More often it's aligned to the deposits that an individual would make. So if you're set up an SIP, you're investing every single month, again, long-term outlook, that's typically a very low frequency of transactions. Emotional involvement, very often we do see that individuals can be glued to the screen itself, where they're paying attention to the charts, trying to understand exactly what's going to happen with the stock in a second from now, an hour from now, and it has quite a bit of an emotional involvement. Whereas with investing, because the strategy itself is very long-term in nature, there isn't any instant gratification that comes with investing. It's more of a delayed gratification. And as a result, there's a lot less emotional involvement. Trading, again, another key characteristic would be more focused on short-term profits, whereas long-term, it's all about the bigger nest egg, the big pot that you're trying to accumulate during a long period of time. Anything you want to add on here, Sadi, before we move on from this page, or you think we pretty much captured it okay?
It's pretty much all captured. We will get to trading strategies on both basically trading and investing, more longer term strategies that are associated with investing and more shorter term that are associated with trading. And we'll delve into what characterizes each one as we go in the presentation.
Amazing. So what can you trade? Well, stocks, the topic of conversation today. You can trade stocks, you can trade ETFs. Some people prefer, say more complex financial instruments for a variety of different reasons, but they can trade options, trade futures. We've even seen cases where people have traded bonds, although as surprising as it might be, because typically these instruments themselves, fixed income instruments, are typically quite slow in moving, but we have seen people who trade bonds as well too for very thin margins. You can trade Forex, and that's a very popular one, and no doubt people have seen posters of trade Forex today, all across the highway. Sometimes you can trade cryptocurrencies, you can trade commodities, and even mutual funds as well too. So there's any number of different assets that you can trade through the use of a broker itself. But what are important topics that I think are essential for you to know, especially at the beginning of your trading journey? I think there's certain, I would say certain just, best practices, but I would say just topics or concepts, I think is a really good starting point. And then that will allow you to kind of take the next step to learn a little bit more. One key one I'll say is that when someone says, well, what is bid and ask? Sometimes you might see, a bit of difference. And sometimes when you're looking to buy a particular stock, you'll see two different prices are reported. One is the buying price, one is the selling price. And you wonder, well, why is there a spread, right? Well, essentially, from a definition perspective, the bid price is the highest price that a buyer is willing to pay for a security, while the ask price is the lowest price a seller is willing to accept. The difference between the bid and ask prices is known as the bid-ask spread. And kind of let me walk you through that. When you're looking to purchase a stock, you essentially are going to the market. And there's essentially a broker that you're utilizing to help you identify that stock, and you're willing to pay for it, and you're making a bid. And if that stock is available for sale, and if the price, that is being offered is aligned to what you're looking to purchase it for, great. The transaction essentially goes through seamlessly. But sometimes there's a question of liquidity. Sometimes maybe, hey, there's a particular company that I'm looking to buy, but I don't really see anybody who's looking to sell it. And sometimes there might be, individuals in the middle, market makers, who are essentially creating transactions by buying on your behalf, finding a seller on your behalf, and they're essentially liquidity providers. And the bid and ask spread, for the most part, is the reward that they receive for essentially creating liquidity within the market. So if I'm not able to find a seller, or if a seller is not able to find a buyer, sometimes there are these institutions who are middlemen, these market makers, who are able to essentially buy from your behalf, sell to their counterparts, and essentially create liquidity within the market, and they get rewarded with that small little spread. Sometimes it could be very, very tight spread where it's almost unnoticeable. It could be maybe 1 to 2 cents difference. In some cases, if there isn't a lot of liquidity in the market, that spread could be quite wide. So if you were to buy that stock and sell it immediately, you might notice that maybe the price that I received, or the value that I received, wasn't exactly the same. That's essentially what the spread is. Market order. What does that mean when someone refers to market order? A market order is an instruction to buy a seller security at the current market price. Let's take, for example, it's 6:16 in the evening at the moment right now, and we know that the US market has opened up. But so, let's just say you decided to proceed with a particular stock throughout the day. 2 in the afternoon, I want to buy NVIDIA stock. Let's just say as an example. The market isn't open. So you have a choice essentially. Well, do I place the trade, and as soon as the market is open, that my brokerage will go ahead and execute that trade for me? Or do I maybe want to put a conditional order to buy at a particular price? Well, in this case, we're talking about a market order where it's essentially going to buy it for you as soon as the market is open itself. And you don't get to dictate what the price is. It's essentially whatever the market price is at the time. Limit order is what we're talking about, or a conditional order, where you can put an instruction to buy or sell a security at a specified price or better. And a stop order, also known as a stop loss, is essentially an instruction to buy or sell a security once it reaches a specified price, which we're going to talk a lot more about at a later stage. Short selling is also, a very important concept, and probably have heard about this, sometimes in passing, or maybe you've come across it, especially if you hear about, the GameStop saga, and you hear about these stocks who are just jumping in value quite a bit, in a short period of time, and you hear about short selling as being one of the reasons. So essentially, short selling is a strategy in which an investor sells borrowed shares of a security with the expectation that the price will decrease. I know, let's wrap our head around it. The idea is that you can actually go to your broker and say, look, I want to borrow this stock. I have a sinking suspicion that the value of the stock is essentially going to go down in the future. And I don't necessarily want to buy it, but I want to borrow it from you, and I'll pay you a premium to borrow it. but I would like to sell it. As soon as I receive the stock, I sell it, receive the cash surplus. And as a stock value, if my prediction is correct, goes down, I buy it back at a lower price and essentially give the stock back to the broker since I borrowed it. And essentially, I've netted a profit because I bought it or I borrowed it at the point where it was, a higher price. I've sold it. And essentially, when the value has gone down, I've purchased it and I've given the share back to the broker themselves. And that's essentially what short selling is. And you're able to make a profit off the back of a company whose the share price may drop during that period of time. Margin trading, sometimes you may have heard about it as well too, is that essentially it's brokerages allowing investors to borrow funds in order to buy securities. Investors must maintain a minimum margin requirement, and margin trading essentially amplifies both gains and losses. So essentially the idea of borrowing to enter into a position itself. Go to the next page here. I can. There we go. Volatility, you've heard about this quite a bit as well too. Essentially, when we start seeing the stock price fluctuate consistently, or it could even be infrequently, could be wide swings, but very, I would say sometimes could be quite predictable or quite boring, and then all of a sudden it might change. We're referring to the degree of variation in the price of that security at any given time. Every stock has its own characteristic, has its own unique behavior based on the industry that they operate in, the sector, based on competitor landscape itself. Typically, high volatility indicates significant price fluctuations, while low volatility suggests relatively stable prices. And you'll notice that some companies are much more stable than others, or some are, of course, are much more, I would say, volatile than others. Leverage, along the same path of what we were talking about earlier about borrowing, leveraging allows investors to control a larger position of a security with a small amount of capital. So sometimes you'll hear leverage of 2 to 1, where essentially they can double your capacity to be able to buy stocks. 4 to 1. We've seen cases of 20 to 1, where essentially you're borrowing at 20 times the principal that you've allocated, which allows you to take a bigger position, which essentially means you're amplifying your trade, or you're amplifying the potential returns, but it also amplifies the potential losses that you may have in any particular stock. So very important to kind of understand these terms and what it means. Liquidity essentially refers to the ease with which a security can be bought or sold. There are some stocks that are much more liquid than others. We talk about the ones that are the favorites that people tend to, recognize, whether it be your Amazons, your Googles, your Microsoft. You never really have to worry that if you're looking to sell it, that will there be a market for someone who's looking to buy it from you. That's essentially referring to liquidity. It's quite instant, it's quite quick. Bar sometimes some very obscure stocks which don't have a lot of volume and sometimes could take a while for you to be able to sell it, or maybe that spread can be quite significant because the market makers are willing to buy it from you, but at a significant discount to the market itself, just because there's no liquidity. There isn't enough sellers and buyers who are interested in, partaking in that stock itself. Diversification, you're going to hear a lot about this at a later stage, but essentially involves the idea of spreading your investments across different assets, sectors, and regions to reduce your overall risk. Whole idea of don't put all of your eggs in one basket. That's essentially, a more easier, more colloquial way to say just make sure you diversify, because it does help to mitigate against market downturns. Technical analysis and fundamental analysis. Sometimes you'll see these two concepts essentially being compared to say which one is better than the other. In some cases, people say a combination of the two is really essential, but it's the idea of taking, let's start with technical analysis. The idea of taking data, especially past market data, where we talk about, primarily price and volume, in order to try to forecast future price movements. Sometimes you'll see these charts, they call them candlestick charts, and you'll look at the patterns historically, how this stock has performed at any particular point in time, and you start recognizing the patterns and try to use this as an assumption of how the future will look. That's technical analysis. Essentially, it's pattern recognition, really, at the end of the day. Fundamental analysis looks at a variety of different things, but not technical aspect of things. Here, they look at the financial health of the organization. They look at business performance. They look at the industry trends. They look at macroeconomic factors affecting their company or security. essentially the idea is to use fundamental analysis to determine the value of a security and make an investment decision for its long-term prospects based on, I would say, a more holistic view of the organization itself. So again, some would argue that using a combination of the two is ideal. And certain markets, tend to, lean in the direction of saying that a combination of the two is essential. But there's a certain market where fundamental analysis is essentially the prevailing, I would say, research, tool, whereas in some markets, technical analysis seems to be the one that you utilize to help you make a great trades. On that note, what we're going to do is we're going to jump into types of trading strategies, and I'm going to hand it over to Sadi, who's been very patiently waiting to jump in and kind of give us his 2 cents. So Sadi, it's all yours. Whenever you're ready, we can talk about trading strategies.
Thank you, Ayman. So we're going to discuss some trading strategies right now, and the nice thing about these trading strategies is most of them you can tell what they are by the name. So the one you see in front of you is called the buy and hold strategy, which basically is buying and holding assets. But I'll get to what characterizes this strategy. Before I jump in, we're going to talk about 3 main strategies, 3 very common ones, and I will give a brief about some others that investors can use, and some of them that actually are used by bigger firms, hedge funds, and all of that. So let's start with the buy and hold strategy. This strategy is, again, as the name implies, a long-term strategy. You want to buy a portfolio of assets and you want to hold on for the long term to benefit from long-term appreciation. So what characterizes this strategy is that, first of all, the portfolio you're buying, you want it to be diversified. You don't want to put all your eggs in one basket. You don't want to put all your money in one stock, and God forbid something specific to that stock happens, like the CEO quitting, or I don't know, like anything specific to a certain company happens, and then you lose a big chunk of your money. In this strategy, you want to be diversified. You can be diversified across countries, across industries, across anything, basically. So you can have some money in stocks, some money in bonds, some money in real estate, some money in different countries. So stocks in Europe, stocks in the US, etc. So in this strategy, you put all your money in this diversified portfolio. And what you care about is your time in the market and not actually timing the market. So it's very hard to time or to know that the market is currently at the bottom and it will go up, or to time when it's at the top and it's going to go down. So in this strategy, you don't really care about entering at the right time. You just want to enter. And the longer time horizon you're in the market, this strategy basically entails that you will grow with the market over the long period, even if you experience short-term fluctuations. Now, a small thing you can do, by the way, and if you're watching and you have Google handy, just search the S&P 500 index on Google, and you should be able to see like a graph that gives you different time periods: 1 day, 5 day, 1 week, 1 month, 1 year, etc. And if you actually see the chart on the 1 day chart, you will see it's very volatile. It's going up and down, up and down. If you go to the 1 week one, it's also volatile, but it sort of has a trend. If you go to the 1 month, you'll see a clearer trend, and the longer time horizon you go, especially if you go to 5 years or to the maximum time period, you will see that the chart has ups and downs, but the more you zoom out, it's steadily trending upwards. And this is what buy and hold strategy is. You want to invest in this index or in any type of portfolio that's diversified and let the market do what it does. Another thing you want in this strategy is you want to reinvest dividends. Dividend reinvesting leads to compounding interest. And a good way to think of this is, if you make 1% on $100, that's $1. If you make 1% on 200, that's $2. So the more you put in the market, the more you'll get out as the economy grows, as the stock prices go up. So you want to be reinvesting these dividends, any payments that these stocks will give you, any payments that these bonds will give you, put them back into your portfolio, and it will grow faster over time. And last but not least, you want to keep monitoring and rebalancing it. It's not a very intensive strategy. You're not checking it every day, you're not checking it every hour, but every once in a while, if one of the assets in your portfolio did very well and now is worth much more than it was, under this strategy, your assumption is it's not necessarily going to do well going forward. So you want to rebalance it to where it was because you want to be diversified and you don't want one position to be worth much more than the others. Now, if we go to the next slide, we'll see some of the pros and cons of this strategy. The pros, it's very simple. Honestly, you can put your money, it's similar to Sarwa Invest with Sarwa. So you put your money in your portfolio and you just let it be. Over the long term, it will grow. Ignore any short-term fluctuations and just, it's a very simple strategy. You don't need to be an expert to do it. Potential for long-term growth, obviously, the longer you wait, if you invest in something like the S&P, you can see proof on the graph that long-term you will grow, your money will grow over time. And lower transaction costs because you're not trading all the time. So you will rebalance from time to time, but that's very rare. You're not putting in money and like selling and buying every day. So less commission cost and less transaction costs in general. Some of the cons is that you need to accept market volatility. I've seen some of the Sarwa Invest portfolios during the COVID downturn in 2020 go down like 10%. And some clients started worrying, like, my portfolio is down 10%, what should I do? Ideally, in this strategy, you want to keep holding on to your funds. Don't do anything, don't sell, because the market on the long term should recover. It took a few months, it took around 6 to 7 months where the market went back to where it was. But during this 6 to 7 months, if you're committing to a buy and hold strategy, you're going to have to accept that at this period of time, the portfolio isn't doing well, my money is decreasing, but I should take it easy, I should take a deep breath and just let it be. Another con is missed opportunities. So sometimes you might see an opportunity in the market, similar to these Reddit meme stocks that go up 100% a day. And if you're committing this strategy fully, you're not going to act on them. So you might think that you missed a few opportunities here and there, but this strategy, again, only focuses on long-term growth, lesser risk than trading in and out of the market, and underperforming assets. So you will be diversified across a lot of assets, and not all of them will do well every day or every year. You will have some underperformers, but this strategy basically tells you this underperformance is not going to persist all the time. Keep this asset in your portfolio because next year, the one that did well this year might do bad, and the one that did bad this year might do good. So just accept that you will have underperforming assets in your portfolio. And that's basically the buy and hold strategy. And I want to now move you from one part of the spectrum to the other extreme of the spectrum, which is day trading. And it's one of the most short-term strategies where you want to trade, you want to do what you want to do on a given day. And by the end of the trading day, you want to have all your positions closed. You want to be out of the market, everything in cash. Now, this strategy is obviously, when you hear of it, sounds more risky. You're doing all your trades in one day. If the market goes down, if this specific stock goes down, you're going to have to close it by the end of the day. You're going to have to accept your losses. So some things that characterizes this strategy is it's obviously very short term. It's within one day. It is high frequency trading. So you're buying and selling in and out in one day, and that's it. You should focus on liquid markets here because you don't want to put an order to buy a stock or to sell a stock, and it takes 2 hours to fill the order because you have a few hours a day to do all your trades. So you want to focus on markets where you can do a trade and it's instantly done. The market does it for you. You buy and sell within a few seconds. And towards the end of the day, all your positions can be closed and you're not stuck holding a position for the next day because you couldn't find anyone to sell it to. The main characteristic of this strategy is that they use technical analysis. Day traders will use technical analysis. And like similar to what Ayman explained earlier, technical analysis is analyzing price movements. You're not looking at the company itself. You're not looking at fundamentals. You're not looking at the ratios. You're looking at the price today and how it's behaving. And you want to see if you can find a trend that you believe you can make money off. Because it's a very short-term strategy. If you believe the stock is undervalued, chances are it's not going to recover in one day. It's not going to show you the true value in one day. So the way you're making money is through how the price is behaving and finding trends that you jump on. Again, I did mention risk management. You aren't taking more risk here. It is much more risky. So you want to be understanding the market. This strategy is very hard for beginners. You want to be an expert. You want to know what you're doing. You want to be tracking the market, understanding what trends are telling you, understanding, watching the news all the time, checking what's going on, because you are trading on these few minutes a day. So it is much more time demanding, and you can't do it by, you can't like stay at the beach and similar to the buy and hold strategy and let it be. You need to be very active. You need to be on it. You need to make sure the trades are going well and you're closing your position by the end of the day. Now, let's talk about some pros and cons of this strategy, because obviously it does have a lot of pros for people to do it. The main pro is you can make high returns in one day. If you get lucky, if you know what you're doing, if you have successful trades that day, you will make returns in a much shorter period of time than a buy and hold strategy. But you might also incur much more losses. So it's a risk return thing. Liquidity. So by the end of the day, you are out of the market. Everything you have is in cash. You're not holding a position over for a few days. So by the end of the day, you have your cash, you have liquid money with you. So that's a pro for this strategy. You can enter another position the next day. Independence, and this is specific to people who do this all the time. You see people who day trade as a full-time job. They don't work an 8 to 5, but they do a few hours a day where they might make money, they might lose money, but ideally they'd make a few $100s or a few $1,000s, and they would call it a day and then do whatever they want for the rest of the day. It gives you a lot of independence to just make money quickly and get out. And no overnight exposure. As I said, you're not holding positions for the next day. So if the market closes and you hear that this stock, something happens for this, something about the stock comes up in the news, whether it's good or bad, you're not going to feel the up or down pre-market movements because you're not in that stock. You're only trading during market hours. Cons, obviously, very high risk. You're going to make money. You might make money. You might lose a lot of money. And if you're down 10% on a stock, you will have to close it by the end of the day. You will have to accept your losses. It is high risk. It is time intensive. You want to keep track of the market, understand what's going on. It obviously does get very stressful. If you have a limited amount of time, anything with a deadline will become more stressful to you. You want to make sure you're making money before the market closes. And with all this buying and selling comes a lot of commissions. So it's much more costly than the buy and hold strategy. Now, Ayman, I don't know if you want to comment on any of the two extreme strategies, but all good.
I would say, look, there's a spectrum. I think you've nailed it on the head, and we're going into the middle of the road now. So we've talked about the buy and hold. We talked about the day trading. Now we're going to talk about something in the middle, which I typically see a lot of individuals kind of put into place on their investment strategies itself, because I think it's a lot more aligned to their lifestyle and their time commitments or availability from a commitment perspective. So I think you kind of nailed it on the head when it comes to day trading.
Perfect. Now, the third big strategy I want to discuss lies between both extremes of the spectrum. So you're not day trading, you're not closing everything within one day, and you're not leaving everything for the long term. Swing trading is a trading strategy where you're in and out of the market, but you give yourself some time. You take a few days, a few weeks, sometimes a few months to close a position. The characteristics, the pros and cons, honestly fall between both. So let's talk about risk, for example. It's riskier than a day trading strategy. It's less risky than a day trading strategy, but it's riskier than the buy and hold strategy. Why? Because if you're in a position that's down 5% today, you give yourself time for it to recover. You don't give yourself a lot of time. So you're not holding it for years. So you might actually incur the loss eventually if it doesn't recover, but you're not closing it by the end of the day. So it's a bit less risky than the day trading strategy. What are you focusing on here? I would say you're focusing on both fundamental and technical analysis. If you give it a few months, fundamental analysis might actually show you like reap results. If you find the stock is undervalued, giving it a few months, you might see that the stock is starting to approach its real value. But technical analysis also plays a role here, because weekly and daily charts can also have trends that you can follow. You don't have to only use technical analysis if you're trading day trading. You can do it over a few days, over a few weeks. So analysts in this strategy will use both. But you can do whichever one you prefer. Does it require market monitoring? Definitely. You still need to understand what's going on in the market. You're not holding for years. You can hold for a few weeks. So you want to see what the stock is doing. You want to understand when to get in, when to get out. It does require patience and it does require adaptability. You want to adapt to based on what the stock is doing. In a few weeks, you see that it's been going down. It's not going the way you wanted. Get out. It's going up. Maybe try to realize your gains. This just falls between both extremes. And similar, the pros and cons, if we can go to that slide, also fall between both. So you have a potential for profit that is higher than just holding for the long term, but also potential for losses that are higher than holding for the long term. It is less time intensive than day trading, but it does require time commitment. It does have less emotional stress because, again, you can hold the stock for a few days, for a few weeks. So you're not panicking if by the end of the day the stock isn't doing well. You can take your time with it. And it offers more flexibility than just buying and holding and never touching the portfolio. Cons, you are exposed to overnight risk. You are holding positions for a few days, for a few weeks. So if news come out on this specific stock that are negative after market, you will feel the effect the next day. The stock will change price the next day. Market timing, so it's very hard to time the market. It's almost impossible, but your market timing will play a role in how much money you make in this situation. Because if you're holding for a few weeks, you want to try to buy at the lowest possible point. It's very hard to know, but if you're following technical analysis and you assume that I should buy at this point, your market timing will play a role in how much money you make. Commissions, you are paying more commissions than buying and holding because you are in and out of the market, but you're not doing daily trades. So it's in between both as well. And limited opportunities, because not all the time you're going to find opportunities that are right in front of you. You might like a stock, but you might think it's overvalued. So you want to take your time. You want to analyze the market. You want to decide when to get in, when to get out. On some days, you might not do any trades. On some days, you might do more than you expect. So it depends on the day and what opportunities come up in front of you. And that's basically swing trading. And I will discuss a few other trading strategies that not a lot of individuals can use. I'll mention which ones can be used, are very hard to actually be done by an individual, but they are a bit more advanced than the other three I talked about. To start off, the trend following strategy is a technical analysis strategy where you're basically following a trend. If you see that a stock has been going up for a few days and you believe the trend will continue for the next few days, that's called the trend following strategy. You want to buy that stock and you want to ride the trend. Similar, if it's going down, you might want to short it and ride the trend downwards. Mean reversion strategy. Now, with mean reversion, you're counting on the fact that the stock price doesn't deviate a lot from the average. So if you have a stock that usually trades at $100, and for a few days, it's been going up to 110, if you believe in this strategy, you believe that the stock will eventually go back down to 100 because that's the average. So if it goes up, you might want to sell. But if it goes down to 90, you might want to buy it because you also believe it will go back up to 100. Breakout strategies are a bit similar to the trend following strategy, where stocks will usually have resistance and support prices. And what these prices are is basically a support price is a price where usually the stock does not go under. So let's say you have a stock that's worth $100 and you see that every time it drops to 90, it ends up recovering. 90 will become this support price that usually the stock will not cross it. A resistance price will be the same price, but it on the upper end. So if you have a stock that is worth $100 and you see that every time it goes up to 110, it rarely ever crosses it, you would start saying that 110 is the resistant price. Now, this strategy tells you that if the stock breaks through the resistance, so it goes above 110, you are going to assume that it's going to keep going up. So you want to jump on that stock, you want to buy that stock, because you assume once you break the resistance, it's going to keep going up. Similarly, if it breaks the support, you believe that it's going to keep going down, so you might want to short sell it, or if you hold the position, you might want to sell it. you want to close the position. Now, this is one that is extremely hard to do as an individual investor. It's mainly used with big hedge funds, and it's called the arbitrage strategy. Arbitrage is basically, actually, I'll give you an example. It's going to make it much easier. Let's assume you have Apple stock trading on the New York Stock Exchange and on the London Stock Exchange. And after doing all the adjustments you have to do, like the currency difference and all of that, you see that the one trading on the London Stock Exchange is trading at a higher level than the one trading on the New York Stock Exchange. Now, at the end of the day, buying any of these stocks, you're buying ownership in Apple. But you see that the London Stock Exchange one is costing you more. So arbitrage is when you see this price discrepancy and you decide that this is wrong and the market will correct itself eventually. So what big hedge funds will do, they will find this discrepancy and they will sell the asset that is overvalued. So the London Stock Exchange Apple, which is a bit overpriced, they will sell that and they will buy the New York Stock Exchange Apple. And they will count on over time the market correcting itself and both the prices converging to one price. So it's what they do is they invest a lot of money. You might make a few cents of this trade, but if you have billions of dollars invested, the few cents will add up and you'll make a lot of profits. But it's extremely hard to do as an individual investor because one, you need a lot of capital, and two, it's very hard to find these discrepancies before someone else because big hedge funds have systems running that will specify and decide what is discrepancy and fix it on the spot. Going to option strategies. Options are basically contracts that give you the option to buy a stock or to sell a stock if you meet certain conditions. A lot of people will use these contracts with the stocks they own or without the stocks they own to create certain payouts. I won't get into them a lot, but you can combine the option to buy a stock and the ownership of a stock and figure out some sort of payout where if the stock reaches a certain amount of money, you sell it. If it doesn't reach that amount of money, you make some premium on it. Again, won't get a lot into it because this is a whole beast on itself, options, but it is a strategy that exists and some investors use it. I wouldn't say it's specifically for big funds. Investors will use it, but it is a bit complicated. Going to fundamental pairs trading. And this one basically tells you if you see two companies that do the same thing and you don't see a reason why one of them would be much better than the other one, and they usually trade at very similar price points, and for some reason, one of the stocks is trading at a much higher price than the other, and there is no clear reason. So you don't see a clear reason why this one is doing much better than the other one. You will believe that eventually the prices will converge. They will go back to the average price they trade at. So you might sell the overpriced one and you might buy the underpriced one. Momentum trading, similar to trend following strategy, is you believe that if a price is moving in a certain way, the momentum will persist. So if a price is going up for 5 days in a row, you believe this upward momentum will persist. So you might want to buy the stock. Similarly, if the price has been going down for a few days in a row, you might believe that the momentum will keep pushing it down. So you might sell the stock. And last but not least, I want to talk about value investing. And this one is a fully fundamental strategy where you will look at the company, you will see the ratios, you will look at their statements, and you will find companies that you believe are undervalued, that are like companies that are good, but compared to other companies in the industry, they might be trading at a lower price or at a price that is not their true value. And based on your analysis, and you decide that this company is actually cheaper than it should be, you might buy some shares in it, and you will consider it a value company, and eventually it should go up to what it should be trading at. And basically that's it on the strategies for now. We will get into practices and what to look at when trading right now, and I'll leave the floor to you. And
I appreciate it. And look, before we move on to as far as best practices, it may feel overwhelming. And this is, by the way, just the tip of the iceberg as far as, various different trading strategies that are available in the market itself. And it's one of those things where you really have to experience it to find the right trading strategy for you. When it comes to trading, you can have two individuals who read the same set of instructions, however, will execute it differently. It's very interesting. So, if you have two individuals who are told that this is the buy-in price and this is the sell price and this is what you should be doing, unfortunately, the execution of that, could be very different because another individual might say, okay, you know what? I don't agree. I don't think this is a great buying price. I know this is what the advice has been. I think I'm going to wait a little bit longer. Another individual will say, oh, maybe this price is going to come back again. I don't think this is the best price that I can get it for. I'm going to wait a little bit longer. So the idea is that no one can, I guess no one can do the learning for you. It's one of those exercises that it's important for you to kind of dip your toes into, get your feet wet, and really experience it so that you identify the right trading strategy that works with you, something that's aligned to your capacity, to your inclination to want to learn more, due to your availability of time and I would say just genuine energy itself, and also emotional tolerance itself. So best bet would be, rather than feeling overwhelmed and trying to theoretically read about all these different trading strategies, start with the basics, get your feet wet, learn a little bit more, and kind of develop your trading skills over time, or through experience itself. Here in this section, we're going to talk about the best practices when it comes to trading itself. And this is essential because we sometimes, in our eagerness to generate returns, we do forget about basics of risk management, for example. Well, the whole idea of risk management is that you want to preserve the capital that you work so hard for, and that you deployed into the market itself. You want to try to minimize your losses and try to find a way to obtain consistent performance. And the way you do that is essentially you improve your decision-making process itself. And how you do that is by removing emotional biases from your decision-making. It's one thing to say, hey, look, I like the stock and I'm going to go ahead and buy it, versus saying, look, I've done my analysis and I feel that, from an educated guest perspective, I think this is the right approach to take it. You'll notice one is very easy to come to a conclusion on, which is it's more emotional. I like the stock, versus the second one requires inputs. It requires effort. And what that does is typically, it doesn't necessarily eliminate, but it reduces the amount of emotional bias that you may have. Because all too often our emotional biases tend to kind of guide our decisions, especially when it comes to money, and you want to make sure that that doesn't happen, or as often or as usual as normal. The whole idea with risk management is that you want to have long-term sustainability. It's all about, as Sari mentioned earlier, it's about time in the market, not timing the market. That has been generally the most rewarding exercise for individuals. So the idea is that you want to sustain and not have a quote unquote blowout, as you would say at times, where you've essentially lost the entire purse itself on a handful of trades. And now you're starting all over again and you need to deploy more capital. So risk management is an important aspect of trading. And there's some tools that you can use built right into the Sarwa Trade app itself. And that tool is conditional orders, or sometimes known as contingent orders. It's the idea of providing instructions through the app itself of when to buy or sell a security, which based on contingencies such as price, being, at a certain, particular level itself. And instead of executing at market prices, you can essentially put a conditional order that's only going to be triggered when those, predefined criterias have been met. So if you want to buy a stock at a particular price, you can put that instruction in there. You can want to sell a stock at a particular price, you can put that instruction into the app itself in advance. So this is a really great risk management tool. To give you an example of the common and I would say the most used ones, let's start with a limit buy order. Okay. And a limit buy order, from a definition perspective, is essentially its ability to buy a particular stock at a specified or lower price. This type of conditional order allows you to instruct at what price point you would like to buy the share. But visually, I think it probably works a lot better if we go through this example here. Suppose that the current price of a particular stock is $55 per share. And you've seen it kind of fluctuating and fluctuation. And you know that at times it may drop to as low as $50. And it tends to be this narrow, I would say, standard deviation in which it tends to kind of fluctuate between. You may decide that, hey, I want to buy this stock the moment that it drops to $50. Ladies and gentlemen, this is called a limit buy order or conditional order, conditional buy order. so that you can set it so that it buys it at $50 and essentially you're buying it at a discount relative to what it was trading at recently. Your buy order is executed at the limit price or better if none is available. This is a buy order, and it's a really great way to kind of manage your risk, essentially. If I go to the second option, which is a stop buy order, which might be a little bit, sometimes counterintuitive. It's like, wait, stop buy order, how does that work? Well, from a definition perspective, it's ability to buy a particular stock when its price rises to a specified level. Wait, that's odd because in the previous example, we were instructing for it to buy at a more favorable price. It was at 55, now it's at $50, and I want to buy it at $50. So what situation would I be in, or what circumstance would require me to buy when the stock price is going up? Well, this type of conditional order is utilized to capitalize on upward price movements, sometimes quite sudden. And it's often employed as a way to enter a trade when the market is anticipated to move in a favorable direction. And Sadi mentioned this earlier before, sometimes there's some breakout stocks that all of a sudden they've hit a certain price point and they just continue onwards due to the momentum that the stock is experiencing. And that's exactly what a stop buy order is here, where if the current price of the stock is $55, but you've seen it in the past jump to nearly $100, and sometimes it just comes in waves and then it drops right back down again. And you want to make sure that if it does go through this wave, this momentum once more, that you get to capture as much of that market as possible, you can put a stop buy order. So if the current price is $55, but if it reaches 60, you can put a conditional order in there to say, hey, make sure you buy it because I think that if it hits 60, it might reach 100, and I want to be able to capture that wave as it's going back up. After a stop buy order, we start talking about sell orders. In this case, it'll be a limit sell order, It's the ability to sell a stock at a specified or better price. This type of conditional order allows you to set a specified selling price, and the order would only be executed if the market price reaches or exceeds that specific limit price. So, very simple example, the current price is $60, and if the price reaches $65, you want to instruct, or you want to essentially go ahead and sell the stock itself for that profit, to essentially on a $5 per share basis, you want to be able to kind of capitalize on that. And that's essentially a limit sell order. And the most simplest example itself is like, I bought it for a certain price, buy low, and when it gets to a higher price, I want to make sure that it automatically sells the stock for me on my behalf. I don't want to sit there and watch the market, for hours on end or for days on end, and just want to set it and forget it, essentially. That's a limit sell order. Very effective trading strategy to help you manage risk. The next one would be the stop sell order, also known as a stop loss order for simplicity. And the idea is that, from a definition perspective, it's a type of order in which you specify to sell a stock when its price falls to a specified level, known as a stop price. This order is used to limit potential losses by automatically triggering a sell order when the market price reaches or drops below a designated stop price. So the idea is that, look, I bought all these assets at maybe $60 a share. I'm comfortable around that level. But the moment that I see that the price drops down to maybe 55, 50, or 45, I'm out. I'm not comfortable with that level of volatility, and I don't really want that level of exposure. So I would like to put a stop loss. So essentially, it's a limit of how much loss I'm going to be exposed to, and you can set that instruction directly onto your app itself. Those essentially is a key risk management tool is creating conditional orders. The second one would be diversification, and we've talked about this, numerous times. It's the whole idea of not putting all of your eggs in one basket, and we won't spend too much time on it, but we essentially just wanted to highlight that it's not just a fad. It's not something that, is something that's a relatively new concept. It's a concept that's actually been in place for many decades. There was studies that have kind of validated the effectiveness of diversification. There was a gentleman named Harry Markowitz, who essentially coined the term diversification and received Nobel Prize for his research itself. And it's something that, funny enough, every institution applies when it comes to portfolio management. There isn't an institution or bank that you would not go to and you will not hear the term diversification. Well, we can thank this gentleman, Harry Markowitz, who essentially invented the concept itself. But it is essential from a risk management perspective to enhance your total returns, to reduce concentration risk. It's the whole idea of not putting your eggs in one basket. And it essentially gives your portfolio the opportunity to grow over an extended period of time. It's about the delayed gratification. It's about building that nest egg, going through the market cycles, reinvesting your dividends. And that's essentially is how you're able to build a portfolio in a very sustainable manner. The third aspect would be emotional discipline, which I think maybe I'll hand it over to you, Sari. And I'm just conscious of time because I want to make sure that we answer as many questions as possible for our audience members, but maybe I'll hand it right over to you.
Of course, emotional discipline is by far my favorite part of this presentation because this is where everything is thrown out of the window. No matter how much you're committed to your strategy, no matter what strategy you're doing, no matter how smart you are, if you cannot maintain your emotions while trading, you're not gonna make any money. When I say that, you don't want to act impulsively. You don't want to be buying and selling and panicking and making decisions based on how you feel. And some ways to help you do that is you want to develop a trading plan and stick to your plan. If you're buying and holding, stick to the buy and hold strategy. Don't stop, don't liquidate your investments and get into GameStop because your friend made 100% on GameStop. Chances are it's already done, it's missed. Stick to your strategy. Don't let your emotions control you. Set realistic expectations. Don't panic when the market goes down. You will see the market go down. You will see your money in the negative. Don't let that influence you. Don't sell everything as soon as you lose $1. That's realistic. You will see losses. You will not make 100% in a day as well. That's realistic. Just make sure you understand what you're getting into. Set very realistic expectations. Use stop loss orders. I personally have had an issue with stop loss orders. I had the stock go down 20%. I owned it and I told myself, you know what, it's going to go back up. I won't add a stop loss order. It ended up going down 80%. So I wish I had a stop loss order. I wish it sold and I regained some of my money. But instead, I almost lost everything because I didn't have an order to just sell when it's going down. If you can go to the next page, we have some other tools you can use is practice patience. Make sure that you're patient. You're not going to make a lot of money in a single day. Even if you're day trading, you might lose some days. Just be patient. The day that you will make money will come. If you're buying and holding, even better. Just you're holding for the long term. Be patient. When the market is fluctuating, it's fine. Let it run its course. It's going to eventually recover. Managing position sizes. I've seen people holding 95% of their portfolios in one stock and the other 5% in real estate, bonds, and diversified assets. You're not diversified. Like, make sure your position sizes show that you're diversified. If you have a basket with 5 eggs and one of them is worth like 95% of all the others, if that egg breaks, you're still gonna face a lot of losses. So it doesn't matter the amount of eggs, but make sure the position of the eggs, the value of the eggs is also diversified. Stay informed, but avoid over trading. I mentioned this. Understand what's going on in the market, but don't impulse buy or don't impulse sell. Avoid over trading outside of your strategy, but it doesn't hurt at all to understand what's going on and why the market's behaving this way. And last but not least, just be self-aware and use relaxation techniques. Don't panic on the spot. Understand that sometimes you might feel something due to anxiety and the strategy you have is still working. Don't impulse sell, don't impulse get out of the position. Be self-aware. Make sure you relax looking at your portfolio because it's money you've earned. It's money that you worked hard for, and it's going to go up and down. So just make sure you are relaxed while looking at it, understanding that it will fluctuate day to day, but don't make any decisions that are outside the strategy, and you should be good going forward. And after this, Ayman, we do have some references for you. We have some informative websites, some social networking websites, and some books that you can look into to get a better understanding about trading. Note on social networking websites, not everything is advice. So you'll see Reddit, you'll see Twitter. A lot of people will post inaccurate information. Just be careful. Don't take everything as advice on these websites. Even on informative websites, understand what's going on, but you don't have to trade based on what they tell you, especially social networking websites, because a lot of people will post things that benefit them and they are not actually research or like they're not actually studied. They're just someone who wants to pump their own stock. So be careful with that.
Amazing. Thank you for that, Sadi. And look, I think the only thing I would really add to this is that when we were talking about it earlier, as far as, trading could be quite involved. And I think the assumption for a lot of people is that when you trade, that every trade is a success. That is, further from the truth, believe it or not. So Sadi and I have colleagues who are full-time day traders where they do it for themselves or whether they work for institutions and they're trading the money of that institution itself. The whole idea is that you just want more wins than losses. And some days that might look like, I might not trade. Maybe the market isn't ripe. There isn't really a great opportunity. And there's certain days where you may trade a number of different times because the opportunity is there. Some people will look at volatility and they'll say, oh, it's too choppy. I'm not really comfortable. I'm probably going to stay out of the market. Where others would look at it as a golden opportunity because with volatility, essentially means swings and some repeat patterns. And this is where a great opportunity for some traders to make some really good dough, as they would say. But the idea is that being Zen-like, it's a really advantageous for you. You have to be akin to a robot and remove your emotions from your decision-making capability. Have a strategy, regardless of what strategy is, but have a strategy before you enter into a trade. Because otherwise, it's equivalent of just kind of go to the roulette table and just picking any random stock. You want to make sure you have something in mind, practice, try it out, see what works, what doesn't work, and then repeat, repeat, repeat if it does work. And that's what I would say is a great way to kind of end the conversation of Sarwa Trade 101. And I want to open it up to Q&A, I think at this point in time. And for those of you who want to kind of maybe get some more content and you want to kind of understand the concepts a little more, number one, this is recorded. So you are going to receive a copy of this meeting today and for you to kind of refer over to, especially the resources. And secondly, there is a booklet that you can download, How to Invest with Confidence. It was published by Sarwa itself, that essentially puts all the best practices when it comes to investing, and it touches on trading as well too, but everything related to investing, you basically can have it in a little small book on hand, or you can just download it. So without further ado, let's go to the first question. Maybe I'll just take the first one right off the bat. We have Hari, who basically asked a question with regards to how many transactions can you do on a daily basis? And I think what he's referring to is that how many day trades can you do? Well, the technical answer to that is that you can do as many as you want, but there are certain restrictions or conditions in order to allow you to do as many day trades as possible. And that is essentially the capital deposit. And I'll give you a little bit of context to this. So there's something called pattern day trading. And it's a little bit of a mouthful, so I'm going to read the definition of it to you. But the idea of what it is that pattern day trading, it's a regulatory rule set out by the US that says that when someone is buying and selling the same stock on the same day multiple times within a week, if you do this 4 or more times in 5 business days, you're considered a pattern day trader. And I'll explain what I mean. If you buy Amazon in the morning, I'm assuming that the markets are open in this case in time, and imagine we're all in the US. You buy Amazon in the morning, you sell it in the afternoon. You buy Amazon again tomorrow and you sell it in the afternoon. You do the same thing on repeat over and over again. This is just one example of which, and you do 4 of these transactions or more within a 5-day period, you're considered to be a pattern day trader. And if you don't have the surplus of at least 25,000 US dollars in your brokerage account, you will not be permitted to proceed with these activities. And in fact, there'll be a temporary block. And sorry, remind me again, I forget how long that block is. I think it's about 1 day or 2 days or give or take something of that sort, where essentially you're not able to place another trade until this time period, this cooling off period is essentially met. But the idea is, Harry, is that you can trade as much as you want. There's no limit on the app whatsoever. But if you don't have a corpus of at least $25,000, you cannot participate in pattern day trading, which is essentially the ability to do 4 or more trades within 5 business days of the same stock. So hopefully that kind of helps there.
I can take a few of the questions, Ayman. I see that Fatima asked, I really wish to learn some basics of technical analysis. We did talk about technical analysis a bit. We did discuss what it does. Some of the basics we discussed were the resistance price, support price, trends, price trends. Now, this presentation isn't focused on technical analysis, but there are a lot of resources where you can get deeper into technical analysis. But in short, we did mention some of the points throughout the presentation. So I hope that that helped with the basics. I wanna. So there's another question: how to rebalance in long-term investments. So how this is done is you want to simply specify a certain deviation that after this deviation happens, you want to reinvest. So let's say you have 20 stocks, each one has 5% in it. You might decide that if the 5% in a certain stock goes to 8%, so it goes 3% up or 3% down, 2%, this is where you want to sell if it went up and buy some of the underperforming assets, or you want to sell a performing asset if it went down and buy more of this specific asset that went down. So it really depends on what what deviation you are tolerant with, and you simply buy and sell whenever you feel like the deviation is crossed. What are liquid markets? So liquid markets are markets where there's a lot of buyers and sellers. The US market is a very liquid market. There are like everyone's trading on the US market. But if you go to a less common market, so I'm from Lebanon, we have a Lebanese stock market that barely trades. It's very illiquid. You want to buy something, it takes hours, if not days, to buy something. So you want liquid markets are just ones where if you put the trade, it does the buying and selling on the spot for you. What trading strategy is to buy just before earning date and sell immediately after? I don't think there's a specified strategy for this for this technique of trading, but I've seen a lot of people do it. You buy before earnings and you hope that the price goes up, and then you sell as soon as it goes up. The pros and cons, it's very risky because you don't know if the earnings will be successful or not. And if they're not successful, if the earnings are not great, the stock might go down quite significantly. But if they are great, the stock might go up significantly. So it's a 50-50. I mean, I don't know if it's 50-50, but it's either you outperform the earnings or you don't. And it's very risky. If it pays off, you're going to make some money. If it doesn't pay off, you might lose a significant bunch of money.
The
I
most
mean,
interesting thing is about this, sorry, is
yeah.
that even sometimes if the company beats expectations, sometimes the stock will still go down because their competitor has beat their expectations at a much greater scale relative to them.
True.
So investors will say, hey, look, I'm happy for you. I know you've done a great job, but your competitor is doing an even better job. So I'm going to sell this stock. And as a result, I'm going to buy that stock. And it's like odd. You had a great quarter, you had a great year, but yet the stocks, it doesn't really reflect that itself.
True.
So that 50-50 can go either way as well. Good news or bad news,
True.
can
True. True.
materialize stock going down or up.
I've seen stocks actually have negative earnings that go up because they beat the expectation. The
Yeah.
expectation was they should be more negative. So it is a risky strategy. So honestly, you can't really predict what's going to happen, but it might pay off.
Well, essentially, it's the stock trading is essentially like a voting booth, really, at the end of the day, right? So the more votes in favor of buying that stock, that essentially means that there's momentum and the stock is going up in value. But if everyone's sentiment is quite negative on that stock itself, regardless of how great that company is on a fundamental basis, on a technical basis, they might have amazing balance sheet, great product range, but if the market says meh, then that stock price will go down, which isn't exactly the most fairest approach. Anyhow, there's a question here by Hassan. It says, are there Sharia compliant ETFs or a list of Sharia compliant stocks? So to that point, yes, absolutely. There is in the universe of ETFs, there are ETFs that are considered to be halal or Sharia compliant, and there are also ones that are not. And for example, if you look at our Sarwa Invest portfolios that we have, one of the portfolios is our halal portfolio, in which it is a Sharia compliant portfolio made up of ETFs that give you access to US markets, emerging markets, developed markets. You'll have exposure to gold. You also have exposure to sukuk as well too. So that's a portfolio that we've constructed on Sarwa Invest that is Sharia compliant. But also, if you want to get into more of the self-directed, you want to buy and sell your own ETFs or maybe your own stocks as well too, there's a number of them that you can find through the Sarwa Trade app. It'll require some research a little bit from your end. So maybe some, I would say off the book research. You might just take a little bit of a Google search to say, look, Sharia compliant ETFs. You'll see a list of them. And it's just a matter of finding them also available on the Sarwa Trade app. For reference, anything that's available in the US market, any publicly listed stock will be available on the Sarwa Trade. So if it's an ETF that is Sharia compliant listed on the US exchanges, you will find it there on Sarwa Trade. What do we got next here? I've used Investopedia Simulator. It's a nice way to start before investing your actual money. That's a really great advice, Mohammed. And for those in the audience who haven't picked up on this, but essentially what Mohammed was saying is that if you used if you go to Investopedia's webpage, they have a simulator, and essentially the simulator is a really great way for it to actually learn about these concepts and kind of help test your knowledge itself. Mohsen said, "Is it possible to talk to you lads in person?" I feel so honored. I appreciate that, Mohsen. Yes, absolutely. You can always book an appointment with our advisory team. So if you go to our homepage of our website, you'll see there's a tab there that says "Talk to an Advisor." You're more than welcome to book an appointment and have a conversation with an advisor. It could be a phone call conversation. It could be a video conversation. So yes, absolutely. Am I skipped any at all? Sorry. No. Let me see. No. Can we expect Sarwa Trade desktop app in the future? It's a matter of when, not if, Mr. and Mrs. Anonymous, for asked that question. Absolutely. It's something that we are looking into it. It's in the roadmap itself, especially as we start offering more tools and more features on the Sarwa app itself. We want to make sure we give you the right real estate to be able to kind of enjoy these features and tools itself. So it is in the roadmap that at some point in time we will have a desktop version of Sarwa Trade. More imminently, there are going to be some product announcements coming out this week. Correct me if I'm wrong, sorry. So some coming out this week. So do stay tuned for some interesting developments on Sarwa Trade.
Yes, and we do have a question about options trading. It's also something we're looking into. So yeah, just keep an eye out on any product announcements.
Absolutely.
Otherwise, we do have some questions, but I know we're running over time, like it's 15 minutes over time. So I do want to say, for any questions we couldn't get to, please feel free to reach out to us. Send them to our help desk. It's hello@sarwa.co. That's our email address. We'll get back to you as soon as possible. But yeah, we've already run over time. Ayman, do you have any?
Yes, 15.
Yeah.
Thank you for that. Appreciate it. We're just having too much fun here. But thank
Yeah.
you to everyone who attended today. This is a topic that we can always revisit. We can have more webinars on this conversation. So if you have any suggestions or any feedback that you'd like to share about this presentation, please do, share it with our support team. We'll be happy to kind of take that on board and make it even better for future presentations. So thank you for joining us today. Sari, thank you, and congratulations on your first webinar with Sarwa. How many years have you been here now? We're talking about 4 or 5 years you've been here, and nobody's managed to convince you to do this, eh?
I'm very happy I did it, and thank you for everyone who joined. Like we had a lot of participants, so I'm very happy. It's I really enjoyed my first webinar. Hopefully, I'll do much more.
Thank you so much. Have a wonderful night, everyone. Thank you so
Thank
much.
you, everyone. Have a great day.